Hello, and welcome to another episode of Deal Hunter. I'm your co-host, Mitch Flax, founder and CEO of Net Equity Capital, where we create wealth through direct real estate investments. My co-host, Tom Staub, good to see you.
Good to see you again, sir. How you doing?
We're doing quite well, man. Good. Always good to see you, buddy.
Yep. Yeah, I'm excited for today's episode as well. It's not a deal, but it's a really important topic. And so looking forward to it.
Yeah, today we're actually going to be talking about how we evaluate deals. And from somebody that comes from Wall Street, I will tell you I think there might be some issues with the way that a lot of people evaluate real estate deals. There may not be as much data out there. And what we really want to do is help you guys break down at least some of the ways that we evaluate deals. And perhaps you might take a few nuggets and ways that you can see for yourself of how you can actually do these deals. And with that, the three things that we're going to start off on, we're going to evaluate the market, we're going to look at the property, and then we're going to identify key areas around the operator and the team in place. Tom, you've had quite a bit of experience being the sponsor on some of these deals. So I'd love your perspective when we're looking at market. What are some of the things that you're looking at from a micro perspective?
Yeah. And again, I think we'll hit on a few other items here as well under this market category, but the micro specifically can be a number of things. And it's really something around, for example, the first thing I look at is how pro build or how pro development is the city that I'm working in. There's a reason that I haven't gone to Oregon, California, New York, Connecticut, in these markets that are impossible to work in. Time kills deals. And if I can't get permits in 6 to 9 months, I'm out, right? I can't wait 3 years like you have to do in California, right? So number one is really around the city and how easy how easy they are to work with. Number two would be just the specifics of the land, right? What's the shape of the land? What's the soil composition? What's the water supply nearby? Is there sewer, power? All these things, help me understand what the cost may be down the road for development, right? So I'm really digging deep into the kind of land, the position of the land, where it's located. And this is very granular details compared to that of macro.
Yeah. So from a macro perspective, obviously we want to look at the growth, right? I mean, that's a given. Is this a dynamic market? Are people moving there? What does development also look like from that perspective? I think you bring up a great point around permitting. I guess I should be thankful that I'm currently building a spec house and it's been in permitting for 6 months. Yeah, I'm sitting here banging my head against the wall, but I guess that might be better than these other areas. Let
me just tell you. So in Arizona, right, which we were actually looking at Joshua Tree and Palm Springs initially for our first developments in California. And we were like, well, it's phenomenal upside, but the risk is timing. We had heard stories from our other developers that were big players 3 years to get permits in California. So we were like, well, let's go to Arizona. And even Arizona, we're still at 6 to 9 months to get permits. So
that's brutal.
Yeah,
that's absolutely brutal. So yeah, I obviously want to look at demographic when I'm evaluating the market. Also, the subsector, whether or not, what is multifamily? Just, a market is one perspective, but what market is it? Is it the storage market? Is it the multifamily? Is this a land deal? What are those analytics compared to other areas? And, one of the things when I'm evaluating the market as well, you obviously want to look at the valuations of that market compared to other markets. Is this the best market? You brought up Arizona. You brought up, Palm Springs. I'll tell you something. I currently ran a model to identify the best places for short-term rentals. The fact that you said permitting is really tough in Palm Springs is now making me rethink that. That was number one on my list. It wasn't Palm Springs. It was actually Palm Desert. And Joshua Tree was right behind there. Extremely strong markets when you're looking at. So when you're evaluating the market, compare it to other markets. You've got to have a large sample set. And what does that even look like? So, I looked at, I recently evaluated the best places for these Airbnb short-term rentals as I'm developing a portfolio there. I have internal rate of returns across all different markets. I'm looking at what the average daily rate, what the occupancy looks like, the seasonality looks like. So, that was just one instance in the short-term rental market, but there's so many different data sets that you can look at.
Yeah. And I would say definitely bookmark St. Louis Fed. I think it's like St. or Fred. Anyways, it's St. Louis Fed. It's a great database for things such as population or permits or housing supply, very macro level details. Redfin data is another one that's free. So you definitely need to be on the pulse, on the trend of the macro. And then once you find something like you're talking about, whether it be Palm Springs or whether it be something like Joshua Tree or Marfa, Texas, to then dig into the micro level to see what does it actually look like, in detail.
Yeah. So lastly, let's talk about some of the potential risk when you're evaluating the macro, especially from a development perspective, whether it be multifamily or what have you. One of the things that I learned in taking the commercial real estate analysis and investment program through MIT, they actually set us up for an assignment to find local reporting or data that we could use in doing our analysis. And here in Austin, looking at the county permits that are being issued and where they're being issued and what type of permits they're being issued, I found it extremely helpful in evaluating some of the local multifamily deals. And you too, no matter where you're at, take a look and see where you can find that public data. Because if you're investing or considering investing in a multifamily deal and you see an area or a neighborhood that's just ripe, prime for development, you're like, hey, this is going to be the first game in town. Well, guess what? You may be right for a short time, but there might be 4 or 5 other multifamilies coming right behind it. And first to market is always, critical. But if the timing on this is something that you really don't know, or they're all coming to market at the same time, what's going to happen to trying to grab those tenants? It's going to be really challenging. It might be.
Yeah. And, real estate, let's not forget, it's not as complex as many other asset classes. I would argue compared to that of like options or whatever it would be. But it is definitely a supply and demand equation, right? So when I think about risk, I think about supply and demand. What's going to affect supply? So back to your point, permits. Who are the other players in the market? Are they going to flood the market with supply? Some of these operators are just careless, like for example, we're taking on a 450 lot development in Lockhart near Southeast Austin. We had the option to do 850 lots, but our thoughts were, well, it's a growing market, it's emerging, but do we actually think it could absorb 850 lots? We said, no, let's take it slowly, right? So controlling that supply. Now you get some players, to your point, that might come in and take down 800 lots, right? Well, that's careless. So the point is understanding the supply side is one side of the equation of risk. The other one is demand, right? What's driving demand? Is it low interest rates for fixed debt on a 30-year mortgage? Do we see tightening on the 10-year coming up anytime soon? What's money supply? What's wage growth? Things that might affect demand will also be important for you to monitor, as well as the supply side.
That's a great point. I love that. Let's get to number 2 on this, because I think this is extremely important when we're looking at and evaluating the property in itself.
Mm-hmm. Yeah, property. Yeah, and there's when I do this, the first thing I do is I dig deep in my proformas, and I think I've shown you my proformas. They're very lengthy, right? I have all sort of scenarios, and even when I'm doing the proformas, I have 5 or 6 scenarios from worst case to best case. But before I get there, the first thing I do is I do look at the property itself, right? Again, back to the idea of what's the shape of the property. Is there a lot of topo, or meaning like elevation on the property? Higher elevation, bad soil. That means much higher development costs, right? So I dig deep to understand what's it going to look like on the timing and the cost of development. How easy is it going to be to get utilities to the land? Those are really the drivers of how I look at viability from a land perspective. And I think my guess is if you're doing like a multifamily syndication or something that actually requires what is known as vertical, which is the building of the properties, you're really going to be, looking at what you mentioned earlier, the tenant demand, the buyer demand, because that's what's going to drive your exit, right? So I would say number one is, what does the land look like, or what does the demand look like for the vertical? And then two, once you have that checked off your list, it's all about financials, right? What are all the scenarios that I mentioned, worst to best case? And on top of that, I also have what I call a crash scenario. And one of your investors asked it perfectly. He said, where's the break-even point? How low can we go on a crash and still break even? And that's a phenomenal question that everyone should be questioning when they're doing their own analysis on these deals, right? And so I have that crash scenario in all my pro formas. And if it's not at least 20%, I think it's a bit too tight, right? I want to see protection down to a 20% correction, because we know typically, the worst case scenario would be a 20 to 40% correction in most markets. And so if we can still make money in that scenario, awesome.
Yeah, let's say 40% wouldn't be a correction, but possibly a
collapse,
an absolute historic collapse and recession.
Yeah,
that wouldn't be the best. And I think a couple of things when you're looking at financials too, and obviously every deal is different. Right now, I'm currently raising funds for Irish social housing, and one of the things that I was looking at on the property side, these were 25-year contracted cash flows by the Irish government. When I'm looking at that property and I'm doing analysis, those cash flows started immediately, right? Whereas perhaps a multifamily, it's going to take some time to get that tenant in there to start paying rent. So what does that time look like? What does that cash flow look like? And what is their go-to-market, right? I mean, that's ultimately what's going to drive their financials. What does their CapEx look like from a financial perspective? I want to see, when I'm evaluating the pro forma, if I see certain areas of the pro forma are increased based on inflation, we'll call that inflation linked, like rents. Typically, you'll see when you're evaluating pro formas that rents tend to go up. Yep. But then perhaps if it's inflation linked, one of the things that I look at and possibly a red flag is when all other expenses stay the same.
Yep.
And I think that's a question. So I think what you can do is use analytics to ask qualitative questions, right? And really kind of dive in with the folks who are sponsoring the deal, ask better questions from a quantitative and qualitative perspective. But generally what the data does for me is help ask better questions. So It doesn't necessarily raise a red flag, but I do want a further explanation on that.
Well, I mean, it can though, right? And we'll get into this in our operator topic here in a bit, but I mean, if the financials don't jive to what you've seen, you have a real problem on your hand about the people that are operating this deal, right?
Absolutely. No, I completely agree. And, the last thing also, when I'm evaluating a pro forma, I do want to see kind of the CapEx and how that looks like. Obviously, you want to look at the capital stack. Who are the players involved? As an investor, where's my protection, right? If I'm coming in as a limited partner, who's ahead of me? What does that senior debt look like on top of the LPs? Where does that GP stand? There's deals that the GP are actually really LPs. And so that might be more favorable for the LPs versus having that segmented out. So I do think it's important to look at the capital stack and ask those questions. Where do I stand if all hell breaks loose and this investment goes south? Can I get my money back at least, or, a portion of my money back? And, the getting is good right now. And I think a lot of people are perhaps getting a bit careless when they are evaluating deals. I will say this is pretty interesting for the folks that use Yield Street or Crowd Street. when they actually provide their analysis or coverage on a sponsor, I'll throw this out there, Tom. Do you have any idea where that information comes from? Guess what? It comes from the actual sponsor. So there's really no third-party due diligence. CrowdStreet, YieldStreet, those types of crowdsourcing deals, the information is actually coming directly from the sponsor. That doesn't sound like third-party due diligence to me.
You know what's funny? I actually I once put a deal on their site that we were evaluating, and you're right, all of their data was coming from my own mouth.
There you go. I mean, yeah. So, I just don't see how you can actually trust some of those quote unquote third party due diligences in it. And I think it's important to really ask questions for yourself.
Yep.
The third part of the analysis that I look at, and I say it's equally as important. I call it my MPO analysis. I look at the market, property, and then ultimately the operator analysis or sponsor, call it what you will. But I want to know what those folks actually did prior to this deal. What did their exits look like? And so, I think certainly you can go on their website and you'll see the accolades that they did and the bravado that they have, which is certainly important. We all do it. We all want to see, let people know what we've done. It certainly helps paint a picture. But, other things that, people may not think about is, what about the individuals themselves and perhaps doing a background check on those individuals? So you could use, any type of website that performs those background checks. Were there any bankruptcies or criminal fraud? I want to know about that. I definitely do. And I think I probably take it a little bit too far there. But, as a fiduciary to my limited partners, I think it's extremely important that who the players and not only their experience, but who they are as individuals. And, I don't care if they got a traffic ticket 20 years ago, but I am concerned about, criminal fraud or anything like that.
Yes.
And so, hopefully, these deals are coming from people that you trust. My network, all the deal flows, I don't go looking for deals, by the way. They come to me. They come to me by way of my network, by the people that I trust, that I've known for a long time. I think you should start there. And if you're somebody who's just trying to get into the real estate game and want to look at real estate private placements, talk to folks in your network. I guarantee there are people who you trust who are already working with trusted sources. So I think that network is very, very important. And as from an experience perspective, not only the sponsor, but who's actually the folks and the players behind that as well, who are working on, perhaps the property management side of things. What's their experience, and look online. A lot of people go, we've been in a multifamily situation, we work with ABC Property Management. Go online to Google, read the reviews of that management, see if they actually respond. Because I guarantee you, most of the time you go on reviews, right? They're not necessarily the most positive, but you can still use that to ask questions and say, hey, I noticed this property had a lot of complaints. Mm-hmm. They weren't getting to maintenance issues. And, that starts to circle, and you may have a problem with, raising rents now, right? Because people are leaving and now you're losing 2 months of getting people there.
Yeah. Well, again, one, knowing you now, Mitch, I actually think how thorough you are is absolutely perfect. Right. And it's made me push my game up higher too, and not just take people at face value or by a handshake or by a dinner, but actually, who are they deep down, right? And you're right. If you go on Google and you type in a company name, and this is what I do as well, you put in fraud, and nothing comes up, great. You put in scam, because here's something that I do know: people are verbose and very transparent if they get screwed over, and you will find a review somewhere out there on the internet if they've been in any of those cases, right? So that's number one. And if that doesn't come back, I think background checks and all that is absolutely paramount. but also just checking to make sure that who you're dealing with are even real, right? I only do business in honest ways with integrity and transparency. And it's way harder to lie your way through a deal than it is just to be honest and deal with the facts, right? And so, absolutely meeting the people on the deal who are running the deal. I would never give a penny without knowing who they actually are.
No, so experience critical. And I touched on this. But the second part of looking at the operator is the exits, right? What did they look like? What did that what did that yield to those investors? Did they surpass expectations or did they underperform? And I'm a big believer, from a sponsor perspective, in setting the right expectation and having a more conservative expectation with a surprise upside on the back end. I generally think that's
I think also exits, I've done a few now in Arizona and of course in Cleveland and, Indiana and Alabama. In all different ways too, different asset classes. But I've learned an incredible amount from not what I'll call mistakes, but from naivete, right? I didn't know what I didn't know. And I learned a lot of that in the last 12, 13 years. And you want people to make mistakes. You want them to learn the hard way, so that when they come to you with a deal, they have the 10,000 hours. They've seen the dark side. They know what happens if you tear down some sheetrock on a house. They know what happens when you start digging up soil. They know what happens if you get into a bind with the city council, right? So if they've had exits, great, and they don't have to be home run exits, but they better have learned a lot from the exits that they can streamline or eradicate in their next deal. And that's I think also really important, not just what they were successful at, but what mistakes they made and what they learned from.
I think that's perfect. Yeah. And ultimately, as you become a more experienced real estate investor, things are going to happen that you necessarily didn't think about.
Yep.
I'd love to pose this question to anybody listening, and feel free to email me at mflax@netequitycapital.com with any questions you might have, things perhaps that you do differently, that, really kind of separate you as a real estate investor. But I'd be curious to know how many people, really do thorough checks. I've got the feeling, and really why I created Net Equity Capital was to kind of be that go-between LPs and real estate sponsors, because I don't think people have the acumen.
I can tell you firsthand. I've never lost one client. Right now, I have a number of clients now, and trust has really been the kind of the pinnacle variable as to why they have stuck with me. Right, and we haven't lost money yet, so that's probably another one. But they take trust in who you are at face value, probably more than anything else. Which, if you have a good salesperson, I can think of a few out there that have scammed a lot of people. Right? They were great at face value, terrible behind the scenes. And one item that we didn't mention that I think it is important to mention, and I see this not even in real estate, but just in business in general. I have a lot of friends that are entrepreneurs. They have their hands in a variety of projects, and they just can't execute. Right? They can't scale up, and it's a problem that many entrepreneurs face, is how scalable you are. Well, you look at these projects, whether it be a multifamily syndication, the Irish housing, the land development. They take teams. They take many channels of work streams, and so you should be talking to these operators too to say, hey, how do you scale your operations? How do you go about your project from A to Z and make sure that you have every piece covered and then operate in harmony, right? So, for example, I have a full-time project manager. She's a CPA by trade. Her sole responsibility is every week she puts us in a room for an hour and smacks the whip saying, Tom, where are you with this? I needed this by Wednesday. Dan, where are you at this? I need this by Thursday. And she keeps us aligned, right? And I wanted her to do that so that we're all, highly functioning. We're able to scale the project and meet timelines, right? But seeing that experience and seeing teams have the ability to truly scale teams and be operationally efficient through a project, I think it's really key too. And there's some ways that you can figure that out up front. Ask them, how do they manage a project? What systems do they use? Are they all email and Word docs, or do they use something like Basecamp or Monday or ClickUp or whatever operating systems it is? right? Do they use QuickBooks or do they, use Excel sheets? I mean, all these small little items will help you understand how efficient they're going to be in a project. And I tell you what, if they're not efficient, you better damn believe that those numbers are going to be way off in the pro forma in the end. So
yeah, no, you bring up a great point, and talk about scalability. I will end on this because ultimately when we decide to do a deal, one of the ways that I always look at an investor is, what does the onboarding look like? Do we make this easy for the investor to sign the sub docs and, get my quarterly payments or monthly payments or annual payments? What does that system in place look like? Because I think that's tremendously important, what that investor interface looks like. So,
that's the next person I'm hiring on my team is like an analyst, investor relations. Because not only do you have to track down payments and make the sub docs easy, you have to build reports. And I do mine every month, right? Where I'm transparent with my investors and I show them what's going on, the hurdles and all that. So absolutely, like having someone to really make it easy for the investor.
Well, with that, I think we covered it. We hit the market, we hit the property, we hit the operator, and I'm sure there's dozens of things that we didn't cover, but we wanted to keep this under 20 minutes and give folks a few nuggets for them to think about. And look, if you've got questions, Tom, where can folks reach you?
Yep. My company, Red Oak Development Group, has a website, Red Oak VC, like venture capital.com, redoakvc.com.
I love it. Well, guys, thank you for listening to us for the next 20 minutes, or the last 20 minutes, I should say. We hope to create a good amount of content for you guys going forward that is actionable and ways that you can actually increase your investor acumen. So with that, take care.
Thank you.